on the scale, so that you know that that is at 8666. More importantly is the centre figure, and there's a measuring tool which is fantastic, because that tells you in the centre that from where you started to where you are now is 411 pips. It tells you that it's 4,110, but you know you take the last one off. Yeah, you know it's 411, you know it's not going to be 4,000 because of the pairing that you're on, all right? But that's 411 pips. So if we now take it from where it closed to where it actually went to, it went to 385. Give the market room to breathe, 20 pips, and it almost got there. Yeah. If you actually take it from the top of the line there, rather than from the close, which is where you should take it from, it was just over the same amount as that there, before it started coming down again. So flag patterns do work, and particularly when 1, 2, 3, 4, 5, 6, 7, that was in there 7 days. There was a week for traders to recognise that it was a flag pattern. Most people had cottoned on by then. Okay, so those are flag patterns. Like I said before, if the market moves down in a quick move and then establishes a flag there, so this is the flagpole, providing it breaks out that way, then if this is 200 pips, once it closes below the support line, you'll get another 200 pips. So that's an inverted flag. Just turn your chart over that you were drawing and you'll see it's exactly the same, all right? And both of those are recognisable as being flag patterns. There haven't been too many kicking around of late, but nevertheless, they do occur. And when they do occur, they're very nice. Right, a channel. A channel is where you have a resistance line and you have a support line. And what has happened is the market has moved into or down to a resistance line, probably stayed there a few days or whatever, but it doesn't matter, then breaks through and it then goes down to a support line. So you've got support and you've got resistance. It was support, once it's broken through, it's come down to here, then it goes back up there to a resistance, then it comes back here to support, then it goes back to resistance, and it can do that lots and lots of times. There are such things as channel traders, and channel traders love the fact that once it gets locked in between a number of lines, these tend to be, by the way, equidistant. The support and resistance lines tend to be equidistant, but they don't have to be horizontal. You can have an ascending channel or you can have a descending channel. As long as they're equidistant and the price action is contained in those lines, then the channel traders will trade it backwards, upwards, and from there to there to there to there. And sometimes it will go on lots and lots of times, lots and lots of times. This one, you've obviously got to have a couple before you know it's a channel. Yeah, before you've got a resistance line and a support line. But let's say you notice that there was a big move there and then it went up all the way back. You probably think that it was going to carry on up. If it carried on up, then you've got 1, 2, these are a bit weaker, 3, 4, 5, 6, 7, 8. That's obviously 9. But you've probably got 9 moves there. Let's say you got 6 of them. Let's be generous. Let's say you only got 4 of them. Yeah. The difference between those two lines is 200 pips. So if you've got 4 of them, you've got 800 pips. That's worth having, isn't it? At £1 a point. At £10 a point, even more worth having. Don't start thinking about trading in hundreds. Triangles. A triangle is where your resistance line and your support line are converging, and at some point there is an intersection. And what happens then is that your resistance line is giving you a succession of lower highs. And your support line is giving you a succession of higher lows. This is even more true in terms of your plumber, because if you go and stand in your garden and you squeeze the end of your hosepipe, it goes a lot long further than it would if you left it as it is, does it not? Yeah. So the pressure is building up. The pressure that's building up in our market here is the fact that people are recognising that it keeps stopping on this line and keeps stopping on that line. So all they're doing is waiting for a breakout of that channel, of that triangle. Here the market closed above the resistance line at that point there. Yeah. And the rules of a triangle are that from the mouth of the triangle there to where the price action actually breaks out there, the price action, i.e. the candles, daily candles, must have travelled towards the intersection by 75%. If it happens at 50% or less, then the triangle rules fall out the window or out of the triangle. Right. This one, I measured it the other day because I wasn't quite sure, because the intersection's over here. It is actually about 70, just over 70. So this one was a bit suspect, but there are other reasons why we took that one, and I'll talk to you about that later. But we were waiting for this triangle because, again, this had gone from the end of May to middle of August. So in those couple of months, there's quite a few people got that on their charts, isn't there? You would all have had it because you would have found it in my update, telling you there was a triangle. So for the next 3 months, you'll know when there's a triangle, because I should tell you. That's good of me, isn't it?
That 75%, it's 75% of what?
The distance. The question was, what's the 75%? The 75% is the distance travelled from here to the overall. That's 100%.
Right.
To the intersection is 100%. The price action, in other words, the daily bars, have had to get into the triangle by at least 75%. Everybody understand that? Yeah? Sometimes they go right up to the wire. Right to there. And it's amazing that, if this was the euro US dollar, this doesn't mean that the amount trading on the euro US dollar has diminished. It just means that in the range, it's exactly the same volume, but it's just contained because they're all waiting for it to break out.
How do you define the mouth?
How do I, what, sorry?
Define what is
the mouth. The mouth is from where you first started to draw the resistance line and where you started to draw the support line, and it's the one that's in it's not that one, it's this one, in other words. It's the inbound, if you like, of the two. That's the mouth. Right. That here wasn't the mouth until that was established, basically. Okay? So that is the mouth of the triangle. So on this particular one, it would be from here to there. I shouldn't do this on camera because I should probably drop myself in it, but let's have a look how many from the mouth of the triangle it was to there. It was around about 560. Let's just have a look how far it went. Let's take it from where the close is above to the high, 530. Give the market room to breathe. It was close enough, wasn't it? Most of you would have bailed out before then because you'd have got so excited about getting a couple of 100 points. You'd have said, I'm going on Kevin Grunwald's course again because this stuff is great. But if you can see a triangle there and you can hang in on there, then at least I would, if that measures 560, I would be thinking about going up for 500, 475, 500. I wouldn't be thinking of 560. It would be nice if it went to 560, and I might protect the trade that I'm in to get 560. But just as an interesting point, can anybody see this wonderful gravestone doji here that established the high after an up move of quite a staggering amount? Wasn't exactly the next day, but it was such a big gravestone doji. Everybody, once it had got to around about 500, was thinking it's going to run out of steam because they'd already measured this at 560. Yeah, and when it starts to get up there and you get 500 there and you get that on the next day, good day to bail out, I think, and take the money. This particular chart shows 3 lines on the chart other than the candles, and these are called moving averages. And to say the least, they are very popular. But before these computer systems came along and the internet, which allowed these sort of charts to be available to the masses, when big traders were doing it years ago, they had to calculate the moving average themselves. And what a moving average does, it actually smooths out these peaks and troughs that you see here. All right? So years ago, before these sort of software packages available, people used to use 10 and 20. Because what a moving average is that you take the close of the day, the figure, and for 10 previous days you add it together, divide by 10, and that becomes a simple moving average. Right? Simple moving average. The reason 10 became so popular is that traders could divide by 10. You just knock the naught off. Very simple. 20 was also popular because it was half a 10. I know it sounds double, but you know what I mean in the calculation. So those two became very popular. It also was popular because 10 days represented 2 weeks and 20 a month, basically, of trading. Yeah? So that's why they became very popular, and people could divide by those very easily. If you've got 10 working days and 10 calculations, what you do is that when the next close occurs, you add that one and take off the 11th ago then. You follow? It's always a rolling 10 or a rolling 20. That's what a moving average gives you. Simple moving average means that you take 10 days or 20 days, divide it by 10 or 20, and that is a simple moving average. There are other types of moving averages called exponential, etc. Exponential really just takes, uses a mathematical formula to, for instance, on 20, it would take more attention or pay more attention to the last 5 or 6 or however many it does. And it would put more of a weighting on the last few days rather than the whole of the 20. But we don't use exponential, we use simple moving averages. Simply trading simple moving averages. Don't get the impression that we're simple. Right, so that's the 10 and 20. However, along came these packages and now you can experiment with whatever figure you like. So as far as our moving averages are concerned, the orange on the screen, the orange line, is 13 days, and the black line is 23 days. Why 13 and 23? I just like 13 and 23. No. The reason we use 13 and 23 is that over some considerable time where we have been monitoring the moving averages, we have found that 13 and 23 are very much in tune with support and resistance, because that's what they are. They are support and resistance lines. And so when the market is moving up in this sort of fashion, you will find quite often that it will sit on this line and when it's coming down it will test the line. Here it's testing the line as support, here it's testing the line as resistance. And sometimes you will be able to see that that will go on for weeks and weeks and weeks and weeks. And every time it gets near to testing this line, it tests it and then bounces back off again. Why is that then?
Because everybody else is doing that.
Great. That's exactly right. If I'd got 13 and 23 on my charts and the candles never went anywhere near it, I would think perhaps my DMAs weren't. DMAs, by the way, I call them daily moving averages because this is on a daily chart. We trade on a daily chart. Therefore, these moving averages are daily moving averages. So the 13 here is actually taking 13 days, the close from 13 days, divided by 13, and that line is then monitoring that figure, following that figure. And the same for the 23. And they're called lagging indicators. And they're called lagging indicators because they lag behind the price action by either 13 days or 23 days. And therefore, when you get a movement like here, where it suddenly shoots up and then down again and then shoots up again and so on, the moving averages there, for arguments, were going sideways. Once it started to get up, it went up and up and up. You can see on that day it reached there and started to come down. It wasn't until this day, which is nearly a fortnight later, that the 13 DMA started moving down. All right. Now, in an up move, generally, the 13 will be above the 23. And in a down move, the 13 will be below the 23. Because they're lagging indicators, and that's what tends to happen. So when you do get a movement that suddenly turns around, at some point, if it continues, you will get a crossover of the DMAs, which enables the 13 then to become below the 23. Okay? So those are DMAs. Now, during the course of last year, early on last year, I was telling people of the 12 pairings to add another DMA, which was the blue, or it's actually teal, but the teal coloured one on there, teal, and like again, you can use whatever colour you like as long as you know what they are. The teal is in fact the 200 DMA, daily moving average. Now that is a long period in anybody's life, 200 days, yeah, and therefore that doesn't move very quickly in terms of changing direction because it's over 200 days. Yeah, it's going to have a lot of movement to actually make it move. But because it is such a well-respected moving average by the markets, you will find when the market is moving towards it, it will take quite some effort to get it through. The reason being is that all these traders know that it's likely to stop there, because that is a major resistance line. You follow? So when it gets there, it's no real surprise that it stops for a couple of days. It might even stay there for 3 or 4 days. It might stay there for a month before it either comes back down or the market finds enough enthusiasm for whatever reason to push it up, back up. In this case, they found enough enthusiasm to actually make it go through. It's probably the bond buying exercise that they decided to do with the euro. There's obviously some major event that's made that push up through, all right? Because the euro was doomed, wasn't it? It was doomed, but now all of a sudden it's gone up there. Why? We're not here to talk about that. That is fundamentals. These are technical. So you can see that when it got towards the 200, we were concerned that it might just stop there. So, going back to what I was saying, of the 12 now, I was telling people to put it on, take it off, because sometimes that 200 would be down here or up here, yeah? And is not affecting the price action one jot, basically. But when the price action is in close proximity to the 200, I used to tell people to put it on. Okay, I am now telling people just put the 200 on all charts, and we'll worry about it when it's in proximity, which it is or has been in the last couple of weeks. And in fact was yesterday, wasn't it? it came down on Wednesday night towards testing the 200. If you were taking a short trade on that, which we'll talk again later, we wouldn't have taken that until it's below the 200 because we know it's like to bounce off it. Because now the 200 is supplying support when it has been supplying a resistance. It's no accident, is it? Look. The market sees it and they go, whoa, not doing that. And that's what happens. Becomes self-fulfilling. Okay, so those are the DMAs, daily moving averages. You've probably gathered from what I've been saying so far that with support and resistance lines and with some of the patterns that we've been looking at, what has happened before, where the markets have got to before, is significant. And therefore, when we are looking at potentially taking a trade in a certain direction, we really do need to know historically what's happened before. So, and I'll zoom out of there so you can get a bigger picture. Incidentally, I presume you all know this, having had MetaTrader, but with the plus and I will deal with the toolbar a little later, but the plus and minus there, if you want to get a bigger picture, if you zoom out, it does actually, this actually at the moment is going back to the 15th of August. If you zoom out and then use the chart shift over there, that's now gone back to the 15th of May. And if you want to go back further, you just keep zooming out basically. The candles get very much smaller, but then you get a bigger picture, don't you? Yeah. And here you can see from that chart that this high that we were looking at fairly recently in August was no accident because historically that's where it stopped before. Yeah? Everybody see that? When the market came from that high all the way down to there, and incidentally, that was over, I don't know whether you know, but the markets tend to come down quicker than they go up. In 2008, for instance, the market fell in 6 months on the pound dollar as much as it had taken 6 years to get from 2. It went from 6 years, it went from a level up to 2, and then in the next 6 months it came down the equivalent of basically 6 years movement. So why weren't you trading in 2008? And were you trading down? Which is more important. Obviously some people weren't, because otherwise the market wouldn't carry on with it. Anyway, that's another story. So we have, when the market got to there, it came all the way back down to here. When it was approaching this level, we were looking at historical data. Now, it obviously stopped here as well, look. See, it stopped there because it stopped there before. So these are levels. Now, some of them might be psychological levels. This one down here is probably 1.52000, somewhere around that. 1.5 was a sticking block. On the, this is the pound dollar, isn't it? Yeah. 1.6 is a particular sticking block on the dollar, pound dollar, in case you hadn't noticed. But every time it gets to around about 1.6, something happens. It stops for a few days because people aren't too sure whether it's going to get through 1.6 or whether it's going to actually fall from 1.6. So historical data is looking back on what has happened before to get an idea of where the major support and resistance areas are likely to be. Now that's going and zooming out over, that's gone back to 2011. If you wanted to go back further, we can actually go back further because the minus, when you've gone back as far as you can in the zoom out, that minus will actually stop. There, look, it's disappeared now. So if you now chart shift that right across, that has actually gone back to 2009. So if the market is, let's say the market were up here somewhere currently, I might say in my update, the market is approaching 1.68, the high of this particular high. After that high, if it gets above there, then that's the next one we're going to be looking at. Yeah, but it's got to close above this one to prove that that one has got possibilities. If it never closes above there, the chances are it's got a long way to fall. And the market loves doing what the market's done because people don't have to think about it. If it gets to a certain point where they think, oh, can you see here, look, major support area. Now you are going to have to draw these on your chart yourselves. Shock horror. I am actually going to be telling you very politely where to put them for the next 3 months, but you are actually going to have to. But can anybody see that there is logic in having a support line somewhere around about this level? On the last 3 touches, it's been around about the 1.53 there. Yeah. But if the market's zooming down here and it's touched there 3 times before, you don't suddenly bail in, take out huge trades to the downside, do you? Some do. But there would be a reason for doing that, and the reason for doing that is waiting for it to close below and then taking a trade if it gets below there. If it doesn't get anywhere near it, there is the potential for orders to open and so forth, which we'll talk about later. All right? So we're always looking to see where the market has actually stopped before and what has happened. So that is historical data. Yeah? There we go. And when we get to, some people say, well, why don't you go from here to there? What I call outer region